So imagine you're a few years away from retirement and you're wondering if you should pull money out of savings to go ahead and pay off your mortgage. This is a common scenario I see with pre-retirees, and it's a really challenging question. Should you pay off your mortgage before you enter retirement? Like a lot of great questions in financial planning, there is no one size fits all answer. It depends, and there's a lot of factors that kind of come into play here. So in this video, I want to kind of break it down. What are some of the pros of paying off your mortgage before retirement? What are some of the cons and what kind of factors should you be considering? Now, one of the challenges here too is that there are a lot of financial considerations, investment returns, taxes, cash flow. There's also emotional components. A lot of people have a lot of emotions and thoughts and mindsets around that mortgage, especially entering retirement. So that is definitely a factor as well. Now, my name is Scott Caulfield. I am a CPA and CFA charter holder and the founder of Sophos Wealth Management. So let's just right off the bat look at some of the pros. Why would you go ahead and pay off your mortgage before retirement? I mean, one, it's just nice to have lower monthly expenses, right? Not having, when you're living off fixed income, having to spend less each month is just much easier, especially from a mental standpoint. Although, when you do that, make sure you don't forget that you still need to set money aside for your taxes, for your homeowner's insurance that used to go into escrow and get paid out of there, or HOA too sometimes. But still, not having to pay those mortgage and interest payments is going to definitely reduce your monthly expenses. Now, the huge reason why a lot of people want to pay down those mortgages early is peace of mind. There is a massive emotional benefit to a lot of people of being debt free, entering retirement debt free, and especially not having a mortgage on their home. We'll talk about, one person I saw this with a little bit later. Another aspect, the pro of paying off that mortgage is it really is kind of like a guaranteed return. I mean, let's say you had a $300,000 mortgage and you had a $300,000 in an investable account, and you're kind of weighing which one do I want to let run? Well, depending on what your mortgage rate is, let's say it's 6%, then by paying it off, you're essentially getting a risk-free 6% return. It's kind of an easy shorthand way of thinking about this. Now, another aspect that's I just kind of put in the pros of paying it off is it even if you don't pay it off, but if you have the money to pay it off, we are ensuring that you have sufficient savings for retirement. As long as you've accumulated enough savings that you can pay off your mortgage and have some other savings left over as you enter retirement, it's generally a pretty good sign that you're in a reasonable financial spot to be able to support your spending. Alternatively, those who are nowhere near being able to pay off their mortgage are often not in a great spot entering retirement and might need to think twice and kind of double check their numbers to make sure that they really do have the cash flow in retirement to meet their spending needs. And if not, they may need to make some adjustments either to their spending or their retirement date. Now, why would you not pay off your mortgage, especially if you have the money there? One, if the risk-free rate of return you can earn is higher than your mortgage rate. I mean, we saw some generationally low mortgage rates. There are people who have mortgage rates below 3. Many people have mortgage rates below 4. For quite a while there, you could earn treasuries were yielding around 5.5%. And even taking into account the fact that you have to pay taxes on the interest you're receiving from Treasury while also receiving a benefit from the interest that you're paying on your mortgage. If you kind of compare a tax-free investment, such as say a muni bond, for many people with those bargain low mortgage rates, they could actually earn a return, a risk-free return, or essentially risk-free, even after taxes that is higher than their mortgage. So in that case, it is kind of a slam dunk from a financial sense not to pay off the mortgage. And even if you were to set the money aside and kind of ladder out certain bond investments to ensure that you had that cash flow to continue paying off your mortgage, you would come out ahead financially. And, for the majority of Americans, I do believe it's something like 70 some odd percent have mortgages below 5%. So, and I think even still the majority are in the threes, twos, threes kind of percent. So a lot of people do have very, very low mortgages. Alternatively, if you're buying a house today and deciding whether to pay cash versus take a mortgage, rates are much higher. So that changes the arithmetic quite a bit. Now, another reason why you may not pay off the mortgage before retirement, and this kind of gets into investment returns again, is opportunity cost. So, let's say that your mortgage is 4 or 5%. Even if your mortgage is say 5%, but you are now giving up those assets that could have been invested at potentially a higher return, right? So stocks have returned something like 10% annual returns over kind of the lifetime of the stock market, at least in the US. That is quite a bit higher. So, while that's not necessarily a conservative investment, if you're 100% long stocks, you got to understand that you may be giving up quite a bit of upside there. So that kind of, there's that opportunity cost of giving up those investable assets. Now, I would advise if you're kind of making this comparison, do I pay it off? Do I keep it in investments? You want to use a pretty conservative assumption on your returns that you think you're going to earn on your investments, particularly on shorter time horizons. I mean, if you're comparing a 30-year mortgage versus 30 years of investment, that's quite a bit different than if you're comparing, say, 5 years, 10 years, depending on how much you still have left on the life of your mortgage. So, just a factor there to take into account. Another thing, if you carry any other high interest debt, if you've got a credit card, if you've got anything else, it's just kind of stating the obvious, but you want to make sure you pay off any higher interest debt first. If you have liquidity concerns, so if you have a $300,000 mortgage and you've only got 300,000 in liquid investments, maybe outside of say just a retirement account, you don't want to be left with basically zero or only about just barely above zero in cash reserves. You want some rainy day funds. You want something to be able to fall back on, understanding that life happens. So we don't want to tap too much. You got to still have some investable assets or some safety net assets there. Also, another thing to take into account, there are tax implications here. So, again, if we use kind of that $300,000 mortgage, so if you're paying on that, you get an interest deduction as an itemized deduction on your taxes. So, one, are you actually itemizing or are you taking a standard deduction? There's one factor in it. But then two, so you would lose the deduction. However, if you've got 300,000 in investable assets and they're earning let's say a 5% return, well, you're paying interest on that 5%. So, that's $15,000 on 300,000 that is going on your tax return as interest income. Itemized deduction may not really be worth, it's unlikely to be worth as much as the income is costing you in taxes, but it's something that you're going to need to take into account for your individual situation. Inflation is a thought process here. You may not want to pay off your mortgage if you expect future inflation to be moderate to high because the mortgage is more or less fixed. I mean, the homeowner's component and tax component might go up, but your mortgage and interest payments are fixed. Meanwhile, if inflation kind of goes higher and higher and higher, the real cost of those of paying that mortgage doesn't really go up as much as say your income and other assets are likely to go up, making it easier to pay off that mortgage. So, if you expect inflation to be high, one reason you may not want to consider paying off that mortgage. Now, outside of these pros and cons, so what are kind of some of the other things you want to take into account with this decision? Obviously, things like what is your mortgage rate? What are those, investment returns? We kind of talked about that. What is your overall retirement savings? Are you in a good spot to make this pretty easy, or are things pretty tight? That's going to kind of weigh on your decision one way or the other. What's your overall risk tolerance? How comfortable are you with having some debt, having some leverage versus how much would you rather just be all cash? Or at least all investable assets, no debt. Again, we talked about those tax implications, inflation, what are your cash flow needs? How many years left are there on your mortgage? Now, one of the things I want to talk about too is just kind of a case study that I saw, way back in 2021. I had a client with a very low mortgage. I mean, 2021 is when mortgage rates were, near some lows. And this client was entering, or not, was only a year or two away from retirement. And it was like really a lifetime goal of hers to pay off a mortgage, to own a house debt free, to enter retirement debt free, have very low expenses entering retirement. And for her, it was really not a financial decision. It didn't matter that mortgage rates were potentially below 3%. It didn't matter what she could potentially earn on investable returns. It only mattered, the value that she would get from the peace of mind of paying that off was enormous. And so she did. And, this is one of those conversations that we didn't really get into too much depth of the financials of it. I kind of mentioned, hey, mortgage rates are so low. I do think that over time you're going to earn a higher rate of return. But that was just kind of a minor footnote because the value and peace of mind she got was so, so high. And, here we go. Fast forward 4 years, it's pretty clear the investable assets, having kept that in investments would have been a much better outcome financially. She never regretted it for a moment. Very happy having paid it off, living a great retirement, plenty of assets, covering all our spending. So it's not always just a pure dollars and cents. Even when the dollars and cents would have worked out better the other way, there's no regrets there. So, something to keep in mind. There are, some middle roads too for those who, you might want to just pay off a portion, kind of have a lower balance, best of both worlds, keep some investable assets, make a lower payment. You could pay it off more aggressively. So, add in some extra payments each month. For those that are younger, if you can kind of consider prepaying a higher amount, it's basically shortening the duration and the overall interest payments you're going to pay on it. And sometimes too, doing things like that, for some people, for whatever reason, it's easier to maybe make a bigger mortgage payment, throw a little bit extra at it each month than it is to take that cash and put it in investable accounts. For some people, those investable accounts are just like cash in the pocket, burning a hole, and it just seems to go out towards other spending. So, again, psychology here is a pretty big deal. And it's something that I would really, encourage you to take into account your own situation. So, happy to hear any of your stories and how you're thinking about your mortgage entering retirement. Obviously, as I mentioned, there is no one size fits all. There's so many factors between your expected investment returns, what your mortgage rate is, to the length of the mortgage you have. But of course, we always want to make sure you've got enough assets to cover that spending in retirement and make sure you're comfortable there. So appreciate you tuning in today. Love it if you like the video, subscribe to my channel, and share it with anyone you think would benefit. Thanks.